So your company has product in the market that's seeing real growth. You've got user growth and maybe even got revenue growth. Now it's time for you to raise your Series A, a $10 to $20 million round that will help your company truly scale. But before you sign just the first term sheet that comes your way, keep in mind these 5 key terms in order for you to negotiate what's best for you and your company. Valuation is often the most heavily contested term on the entire term sheet. It's a negotiation between you and your investor trying to set the value of your company. So the investor wants that to be as low as possible, and the founder wants it to be as high as possible. The higher the valuation means that you are giving away less of your company while bringing more dollars in to scale the growth. Now, keep in mind that as soon as you're talking about valuation, you've entered a negotiation and you want to keep your terms straight. Specifically with valuation, the most important thing to understand is whether when you're discussing valuation with your investor, if you're talking about pre-money valuation or post-money valuation. The pre-money valuation is the valuation of the company before any investment comes into the company, and post-money valuation is the value of the company after the investment has come into the company. So when an investor says, I'll invest X dollars at Y valuation, they often mean post-money valuation. Here's why the difference matters. So let's assume you're raising a $20 million round at a $100 million post-money valuation, then the investor gets 20% of the company. If you're raising a $20 million round at a $100 million pre-money valuation, then the investor gets 16.67% of the company. And that's a pretty big difference. Another term to keep in mind is the option pool. This is a non-obvious term that actually affects the valuation of the company. So an option pool is simply this: the amount of stock that you've set aside to incentivize new hires as you scale after your Series A. Now, if the investor is able to push that option pool size too high, what ends up happening is the founders and the early employees end up getting diluted more than the investors do. So watch out for that. It can be a backdoor way to effectively lower the valuation of the company. As a rule of thumb, Series A's should generally have around 10% option pool. Founders who display a clear understanding of the terms of a valuation earn the respect of their investor and give themselves an advantage as they're moving throughout the rest of the negotiation. Establishing your competency early is going to be important, especially for this next term that could really impact how much money you end up walking away with when your company succeeds. Before we get there though, I need to remind you that none of this is legal advice. If you're raising a Series A, you definitely want to hire competent legal counsel. If you don't have any, feel free to reach out to us at westaway.com. And while you're there, you may want to check out our Founder's Guide on the Series A, which is a much deeper dive and much more detailed look at the Series A terms. Liquidation preference. Selling your company may be the farthest thing from your mind right now, but as you take on Series A investors, you need to think about the exit right now. You want to make sure that you don't walk away broke while your investors take all of the money. As a founder, you want to make sure that liquidation preference multiple is low as possible and that you're negotiating very strongly against investors that want to fully participate. The term has 2 key parts to it. The first is the preference. Preference is usually expressed as a multiple, so 1x, 2x, or 3x. A 1x multiple would mean the investor gets 100% of their money before the other shareholders get anything. A 1.5x would mean they get 150% of their money before any other shareholders get to take anything. Now, let's look at an example. Let's assume your company was acquired for $22 million and that you have an investor that invested $1 million for 10% of the company at a 2x preference. So they'll take 2x of that $1 million, they'll take the $2 million off the top, and then the additional $20 million will be shared by the other shareholders. Now, does that investor also get to take a share of that $20 million? Well, that depends on their participation clause. The participation clause dictates whether the investor is also able to participate in the pool that's set aside for common shares. So there are 3 types of participation: no participation, full participation, and capped participation. Let's take a no participation first. No participation means that after the investors take their multiple off the top, they don't see any other dollars. So in our example, whereby the investor had a $2 million preference and there was a $22 million acquisition, they would just see those $2 million and they would not participate in the other $20 million. Full participation means that the investors both take off the top and they get to have a pro rata share of what's left over. So let's use an example to explain this. Again, let's go back to our $22 million acquisition, whereby the investors invested $1 million for 10% of the company at a 2x fully participating preference. So here's how it would work. They would get their $2 million off the top. Again, that's that $1 million times 2x. And then they get 10% of the remaining $20 million. So in this case, that means they get another $2 million for a total of $4 million they're walking away with. That $2 million is really coming out of the pocket of the founders and their early stage employees. Lastly, we have capped participation. Capped participation is a variation on full participation, except for it sets an upward limit on the total amount that the investor can walk away with. So let's go back to our example, a $22 million acquisition, whereby the investor invested $1 million at a 2x preference, and in this case, they have a 3x cap. So again, they'll take that $2 million off the top, and out of that additional $20 million, they would, if they were fully participating, they would get another $2 million. However, there's a cap of 3x in this example, and so in this case, the most they could get is 3x that initial $1 million investment. So they would walk away with $3 million total. The bottom line is, at an acquisition, this is a zero-sum game. The pie is only so big, so the bigger the slice that the investors get, the smaller the slice that founders and early-stage employees are getting. It's really important, it's super essential that you work with your counsel to negotiate incredibly vigorously against any investor that's seeking to have full participation rights. The most common liquidation preference we see at Series A is a 1x non-participating preference that ensures that the investors are getting their money back and that the founders and employees are rewarded for building the company. If you're enjoying the video, make sure to like the video and subscribe to the channel so that you can stay up to date on all things legal for startup founders. Now let's check out the anti-dilution clause. The anti-dilution preference comes into play when you raise a future round of funding at a lower valuation than you did your Series A. This is known as a down round, and in general, down rounds are seen as a signal that the company is not in good health. In the event of a down round, the anti-dilution preference protects the investor from dilution and instead forces that dilution on the founders and the employees. Without getting into too much complex math, the thing you need to remember as a founder is that you want to push hard against a full ratchet anti-dilution preference and instead push for the much more standard, broad-based, weighted averaged version of the term. Pay attention to terms like these. You have to negotiate with the assumption that there will be tough times. The drag-along right is simply the right of a certain set of shareholders to force another set of shareholders to sell the company. In its worst permeation, that would allow a single VC to make the decision to sell the entire company. Ideally, you'd want to negotiate the drag-along right out altogether. If you're not able to do that, then you'll want to expand the pool of people that are required to exercise this right. So instead of just having a majority of the Series A investors, you'll maybe want to say a majority of the Series A investors plus the board of directors and even plus a majority of the founders need to sign off in order to force the sale of the company. Raising a Series A is a huge step forward for the company, but it also comes with a greater struggle for control. Now, as a founder, you want to make sure that you're retaining as much decision-making power as possible. And one way to do that is to ensure that you trust the people that are guiding the company. The composition of the board of directors is one of the most, if not the most important terms in the term sheet. The board of directors guides the company, they hire and fire the CEO, and they have final authority on a lot of decisions in the company. Now, as a founder, you want to retain as much power on the board as long as possible. And what that means is keeping a majority as long as possible. The board evolves over time. What started with, say, just like 3 founders on the board will eventually shift to a board that's made up of founders and investors. The general rule of thumb is that 1 new investor comes on for each round of financing. So we'll say there were 3 founders on the board, and then 1 investor came on in Series Seed, another at Series A, so then they're 3-2, and then at Series B, it's a 3-3 tie. The important thing to note is that the dynamics on the board will shift as the majority power shifts. So it's in the founder's best interest to ensure that they maintain a majority for as long as possible. But in addition to just like counting noses to see how many investor seats versus how many founder seats there are, it's really important to ensure that you have quality people within those seats. At the end of the day, you want whoever's sitting in those seats, whether they're investors or founders, to be aligned with the mission of the company, to add unique value to the company, and to make sure that they are people that you want to go through good times and bad times with, and people that you think are wise and you trust their opinion. Pick board members who understand the company's vision and are aligned with it, and you believe will do everything they can to make that vision come true. When you understand these key terms, you'll be a savvy negotiator and you'll ensure that you don't lose control of your company. If you're interested in more startup legal tips, make sure to check out this video to see if you're making rookie legal mistakes.